Well, thanks. So my name is Joey Barrow. I've been in mortgages and real estate for 25 or so years, and I'm a CIO and co-founder of Home Lending Pal. I have an extensive amount of mortgage background, underwriting, and what we're trying to do. Well, this is my first presentation of this, so please bear with me if you will. So, how many of you how many of you own a home? So of you that own a home, did you get a mortgage to get that home? You don't have to answer this question, but a lot of people who go to get a loan, they're nervous about it. They feel, the one thing they don't want to be told is no. And what we're trying to do is create a easy access to information, kind of like Zillow, Redfin, and Trulia upset the real estate industry by opening up MLS to the consumer. Because now they can go and search all these properties and not have to talk to a realtor. Yeah. We're looking to disrupt the mortgage industry by opening up the guidelines and the agencies and programs that are available to the consumer, similar to like Zillow, Redfin, and Trulia have done. So one of the things that we see, that I see a lot, is the people may be told no on a loan where some other lender could do that same loan. So I'll give you an example. So this big veteran area, is anybody here in finance or real estate? So debt ratio. Do you know what I mean by debt ratio? Like your total debt versus your income. So the typical lender, and you can call any lender, any bank in town, and you ask them, what is your max debt ratio for a VA purchase or a VA loan? And 9 out of 10 are going to tell you 50%. The other 1 out of 10 is going to probably tell you 45. Or you might get somebody that says 55. But VA's guideline states any debt ratio with an automated underwriting system approval. So you may have a veteran that goes to a local lender and they're told no, they can't, sorry, I can't help you. Then that veteran thinks, well, I can't get a loan. Or they may go to a lender number 2. I told you 9 out of 10 are going to tell them 50% is the max debt ratio. So they go to lender number 2, and lender number 2 says, no, I'm sorry, I can't help you. Well, their debt ratio might be 53, or maybe it's 56. And maybe there's reasons that, like maybe the wife's credit score isn't high enough. So there's another income in the household, but we can't put that wife on the loan. So there's reasons that you could potentially have a higher debt ratio approval. Most buyers, they only go to 2 lenders. Once they hear no twice, they're not going to go to another. They already didn't want to go to the first. They're scared, nervous to go to the first because they don't want to hear no. So then they went to the second and got told no again. And the sad thing is that if they went to maybe a third lender who does have the ability to go to the higher debt ratios, they could have been told yes. So VA's guideline states any debt ratio with an automated underwriting system approval. I've seen debt ratios as high as 67, 63, 62, which means there's a ton of people that have been told no by other lenders that could have been told yes by a lender who didn't have an overlay or a cap of like that 50%. So overlay, and I'm kind of give you a little bit of some mortgage terminology here, but overlay is a guideline that exceeds the agency guideline. So VA says any debt ratio. ABC Bank says I can't go above 50%. That is an overlay for that bank. Credit score is another big thing that we see. So a lot of banks won't go below 600 credit score, 620 credit score, maybe even a 640 credit score for a VA loan. But you can actually go down to 580. But there's only probably 1 out of 10 that will go down to 580. There might be 2 out of 10 that go down to 580. There's more banks and lenders that will go down to a 580 than it will go above a 55 or 50. So and I'll give you some other stats. So the average credit score across the United States is 680. It's like 686. It's stayed around that 680 for years. The national average credit score of a person buying a home, closing on a mortgage, is 758. And it's a lot of reasons that I believe, and we believe, one of the reasons we started Home Lending Pal is because there's a huge disparity of consumers that could buy that. First off, they were maybe too nervous to go call that lender. I'm just going to keep renting. My family's always rented. We've never owned a home. You know, I think my credit score may not be all that great because I got medical bills, and medical bills now affect credit score a lot less than they used to. So there's a lot of consumers that never even go. They never pull the trigger. Never go to talk to a lender. And there's no online. There's truly not an online company like Rocket Mortgage. Everybody's heard of that, and I'm not trying to knock Rocket Mortgage, but you cannot get an automated approval through Rocket Mortgage. You have to talk to a loan officer at Rocket Mortgage, and Rocket Mortgage is Quicken. So they're still having to talk to somebody to get a response. So there's millions of consumers across the country that never experience home ownership because first off, they're nervous, don't want to hear the no. They just figure, well, the lending guidelines are so strict, I probably won't get approved anyway, and they never actually try. So again, the national average of credit scores for a mortgage loan in 2018 was 758, but the national average of a credit score of the consumer in the United States is 680. And I just shared that that lending can go down even to a 580. So there's a huge gap there in potential homeowners that they never realized the opportunity of home ownership. So what we're trying to do is help that area. There's on average last year there was almost $2 trillion lent in mortgages, and of that $2 trillion lent, about 30% of those people did online applications, but they didn't actually do an online. Online application just means here's all my information, then a loan officer calls you. What we are doing, what we have is we have an artificial intelligence system that scrubs the guidelines for all the agencies. So a consumer comes to our site. This right here. So our solution, artificial intelligence, OCR, which is ocular character recognition. Basically, a consumer can go to our site, put in all their information. We scrub the credit bureaus. We pull their credit. We scrub the agencies, all the agency guidelines, to see what they could qualify for, to give them an unbiased opinion of what we feel like their approvability is. And then we match them to a lender that can do that loan. So let's just say they are a 60% debt ratio borrower, that they would have been told no by 9 or 10 of the people that they would have called. We already know that they're above 60. And then we have a lender that we can match them to that we know can do that 62% debt ratio. So again, this artificial intelligence, we've got a whole group of people behind us. We got a team of about 8 people so far. 4 of them are data scientists. And again, we're scrubbing all the agency guidelines in order to build up our AI. And again, we're still in development stages. We should have our minimum viable product mid-September. So we've already worked out some agreements with, I'm going a little ahead of myself. Again, this is my first presentation on this, and I apologize. I should have done a little bit better job rehearsing or practicing for this. But what we feel that was going to happen when we give more education to the consumer, then it's going to shorten that buyer process too. So the typical from application to close is 30 days, but the typical time that a consumer decides I want to buy, or I'm thinking about buying, then when they actually buy is about 6 months. So that's 6 months of time that they could be researching guidelines, looking through documents. We have a chat bot that's being created that can help with, give you this artificial response and information based on what you uploaded and the scanning of the documents of your pay stubs. And we're scrubbing, we connect with, we have a system called Play that connects with over 10,000 banks and financial institutions to gather bank account information, credit card information for up to a 2-year period. And we analyze their spending habits and just give them guidance on what we feel is in your best interest for lending. We wouldn't really recommend somebody to necessarily push forward on a 62% debt ratio VA loan. But if there's, And if there's a spouse in the household that maybe they're not on the loan because of credit score, then maybe that does make more sense. Or maybe their income is much higher, and at 62% debt ratio, they still have a lot of disposable income. Disposable income in after you paid all your bills, what you got left over. So, again, we're building the first robo advisor. It's got asset verification, gives you approvability odds, credit scoring, and then just financial recommendations. So far and again, we're a startup company. We're targeting North Carolina as our beta state. And so far, just through organic searches that consumers have made, we've not paid to market this at all online, because again, our website is still in development stages. If you go to homelendingpal.com, you can sign up, and it tells you what's going to be available in our future rollout of the product, which again is mid-September is what we're expecting our product rollout to be. But in the our website actually went live, available for a search opportunity only earlier this year, and we had about 3,000 users that had already said they had interest and they want to learn more once it comes available, knowing that it's not available yet. But we've had over 3,000 users that found us organically. The average consumer doesn't want to be sold; they want to be educated. They want to make the decision on what they're going to buy. They don't want to be sold. So what we're trying to do is provide education to the consumer so they can make a very educated decision, and then go into that conversation with that lender already knowing the answers because they've already spent this time incubating within our system, and the 6 months or so has gone by that the typical consumer has the idea of buying before they actually do buy. Yes, sir.
How do you make money?
We make money by selling the lead to a lender. That's how we make money. We don't charge the consumer anything. We give the consumer an unbiased opinion on what loan product that they could qualify for. And then the consumer has to raise their hand. We don't sell the consumer's information. It's not like once they get on the system, they're now being bombarded with all these people calling. The consumers, until they raise their hand and they pick a lender that they want to talk to, there's no lender that will be involved in their whole experience within our site.
So the transaction, once it goes to a lender, they pay you? Does the lender know ahead of time?
Say that, I'm sorry?
So you send to the lender. Is there a fee coming in from different lenders, or just that one lender that you send it to?
Only that one lender that we send it to.
And if he doesn't want to take the loan, then you won't get paid?
Now, he does either. The lender would register for what loan products that they have interest in wanting to sell. Which brings up another point. So there are, how many 100% options do you think are out there for financing? Like for mortgage lending, how many options do you think there are for 100% financing? VA is one. See, that's what most people think. A lot of, the media says you need 20% down, you need money down. Lending guidelines are strict. Everything's tightened up. I've been in lending for over 20 years. Well, just right at 20 years. The lending guidelines, there are some things that did tighten up, but the 100% loans have not gone away. There's more loans out there other than VA. There's a conventional down payment assistance loan that's a 99% loan to value and 101% loan to value. There's North Carolina housing. There's bond programs. Every state has a bond program. There's North Carolina housing finance that you can do a conventional down payment assistance. You can do an FHA down payment assistance, and you can even do like a USDA and a VA down payment assistance. USDA is 100% financing too, but maybe you can't get the closing costs financed into the deal. You can finance the closing costs on top. There's 1, 2, 3. There's like 5, 6 or so. There's also the Chenoa Fund, which is another down payment assistance, 100% financing. So there's about 6 different 100% financing options out there. But most people think VA is it, and if they know even what the USDA loan is, that's the only other one. But there's other 100% financing options out there. Not every bank is willing to do those other 100% financing options. And it's because from a bank's perspective, every loan doesn't pay the same thing. Like a government-backed loan, a bank will make more margin on a government-backed loan than they will like a conventional loan or like a housing finance bond loan. Those are some of the lowest margin loans that are out there. So there are some banks that don't even do the bond loan. There's some lenders that don't even do the bond loan. There are some lenders that don't have access to the 99 and 101% conventional down payment assistance. So if you just randomly called, you looked in the phone book and you started with, nobody looks in the phone book. You went online and you found the first company that you found online and you called them and you just assume, well, everybody's the same. They told me I don't qualify for a VA or I don't qualify for an FHA. Then why should I call somebody else? And the thing is, they may call that lender. They say, well, you don't qualify for FHA. But that lender may not have access to bond, or maybe they don't even want to sell the bond loan because it's too much paperwork. Again, I was in the mortgage industry for 19 years now, and early on in my career, I had never done an FHA loan until about 2006. So prior to 2006, I'm like, FHA is just too difficult, too much red tape, I don't even want to do it. And I'm just going to do these other loans that are easy. And that's what you still see today. There's a lot of lenders that just don't do the harder loans, even though it might be available to them. So what we're trying to do is give access to all this information to the consumer so they can make their own make their own decision, and the lenders that don't do those bond loans or they don't do those higher ratios or those lower credit scores, they're not even in the mix of. They don't even have the opportunity for that lead anyway because they've already said that I don't want to do these, because the lender would give us their parameters of what they're willing to fund. We know what's available through the agencies, and it might be that it narrows it down to who could even this lead would even go to, because there's only so many lenders that are willing to even do this category. What happens too is you can have somebody who's got money for down payment for just say an FHA loan. They've got money for down payment, and the loan officer doesn't even share with them, well, there's actually a 100% option you can do. And most consumers don't have a ton of money, especially the millennials, which is over a third of the buyers today. They don't have a whole lot of money in the bank. So let's just say they got $5,000 in the bank and they need $4,500 for closing. And that loan officer sold them an FHA loan when they could have just done a North Carolina Housing Finance FHA loan with down payment assistance, and then they kept their $5,000 in the bank, so they have that cushion. It just helps with their stability and helps get it. They're not depleting everything in their account. Even though the guidelines do allow for FHA, you don't have to have reserves at certain credit scores. But that loan officer may not have offered that to them because it's a harder loan, or maybe they just don't offer it. So that's what we're trying to do here. So again, there's 3,000 people that had found us and signed, or more than that found us, but over 3,000 signed up organically up until June. In June and July, we had over 4,000 people that found us organically. So we're now to over 8,000 users on our site waiting for this to come available, waiting for our site to be active. Yeah. The need is, the market's there. The need is there. So this talks about Plate, which is a company that we partnered with that gives you the access to the different bank accounts and credit card accounts. Then we partnered with Equifax. Equifax in the credit bureaus is a very difficult thing to get access to because of security reasons. And it says at the top 2 years. We actually started Home Lending Pal about 2 years ago. And we started the idea, the concept, about 2 years ago. And it was only in June that we got to a point where Equifax agreed to make an exception, because we're trying to educate the consumer, be an advocate for the consumer. They've actually changed. They're allowing us to do something they've never allowed any other company to do, and we're like a beta test for Equifax, which it's kind of gives me a little bit of goosebumps, because Equifax is a huge company, and for them to be willing to allow us to be a beta test for them on how they're allowing that information to kind of flow through. I don't really know. I'm not a behind the scenes kind of technology guy. I don't know that piece of it. I know the consumer. I know the mortgage lending. That's my expertise. But there's something about how that information flows and security of that, and then storing it on Equifax's data. Anyway, the more I talk about it, the dumber I'm going to sound. So I'm going to move on. So our business model, we really basically have two people that we're serving. One is the consumer, and then the other is a mortgage lender. We are an advocate for the consumer, and we're not. While the lender pays us, we're giving an unbiased opinion to the consumer. The consumer then they see, each lender has their own rating based on how long it takes them to close a loan, the feedback from the consumer. All this is being built over time, and the consumer gets an opportunity to rate that lender. And then they'll be able to see ratings, just like on Zillow, you got ratings for realtors and lenders. Same type of thing is built on our site. So the consumer gets to pick. So what we're doing, benefits to the borrower, gives credit risk insight, affordability, builds literacy, and providing an unbiased opinion of what we feel their approvability odds are and the best loan product for them. For the lender, we're giving minimize uncertainty, maximizing their net value, and increasing efficiency. So from a lender standpoint, Zillow sells leads to lenders. Like a consumer goes to Zillow, they can have multiple lenders call them. And Zillow charges like $80 a lead on average. That's about what it charges. And the Zillow conversion is like 3%. So from a lender standpoint, it's a ton of money they're spending. A ton of credit pools that they're spending money on that for a very low conversion. Lending Tree well, I'll get to that in a second. That's on the next slide. But anyway, our conversion, we're expecting to be very, very high, like 50% conversion of our leads. Because the client, we already know what the credit scores are. We've already analyzed their the agency guides to see where they fit. We've already analyzed their bank accounts. We've already pulled data, from the credit bureaus, from the credit card companies. So all this has already been analyzed. So when that lender gets this lead, it will be a very high quality lead, higher quality lead than anything else out there. So, we're automating the process, minimizing paperwork. So, we're kind of like, do y'all know what Mint is? Are y'all familiar with Mint? So Quicken years ago, initially was like a bank account kind of system. Y'all know y'all ever used Quicken years ago? So it's like a money manager kind of thing. Mint's the same type of thing, but all it does really just kind of pulls your data in and here's your data. I mean, it really doesn't analyze anything. It's just like, here's your total credit card debt. Here's your total monthly payments. Here's your bill coming up. That's really all Mint does. And that's what Quicken did years ago. But we're kind of like a Mint because we can pull all that information in, but then we're also giving guidance on what loan products they can do and ways to minimize their debt. So we're kind of within this area of Zillow's and Lending Tree, Bankrate, Credit Karma, but we're totally different. There's no company like us. Like Credit Karma, y'all know of Credit Karma, right? You get free access to your credit report. Credit Karma's in the business of selling credit cards. So they give you free access to credit card to your credit report, and then Credit Karma send you all these emails about here's a credit card we feel you're best for. And we're similar kind of to that because here's the best loan that we feel that you'd be best for, but we're not having a lender connect to them until they raise their hand and say, hey, I'm ready to talk. And this is the lender I want to talk to, or these are the two that we want to talk to. Just to kind of tell you about how we differ from like a Bankrate or Lending Tree. Everybody's heard of Lending Tree. So Lending Tree, you go on the Lending Tree, all they're doing is they're just showing you the lowest rate, and the consumer fills out some information, they get 5, 6, 7, 8, 10 companies calling them. So so there's no analyzing that's ever been done on the consumer. It's just the consumer says I got great credit and here's the loan amount I want to, or purchase price I want to do. Then they got all these lenders calling. Where we're different is that we still give them we can give them an average of what the rates are. We still give them all the guidelines, but no lenders call them again until they raise their hand. So market validation, over 58% of buyers in the country were first-time home buyers. And of those, 98% of them started their home buying process online. And a third of the home buyers are millennials. Change. Market opportunity, there was in 2016, there was over $161 billion worth of mortgages that were originated online, that started online. There was $1.7 trillion of mortgages lent, but $161 billion started online, started with an online application. They're expecting it to be 250 million by the end of 2020. Expecting over $250 million worth of mortgages are started online, and the more automation, the less human interaction is just kind of the direction that lending is going. So, again, this is just kind of talking about kind of the market, what we're looking at. I mean, what our kind of expected revenue over the next couple of years will be. It's kind of our roadmap. So this is this section on the side is, so the summer disrupting origination. This is what we're kind of in the middle of right now, kind of connecting with the soft pull on the credit, because the credit pulls that we're doing through Equifax are considered soft pulls, so it doesn't hurt the consumer's credit report. So no one else would ever see that their credit's been pulled. So it's not impacting their credit negatively by going to our site. The processing piece in the fall, once we go live in September, we're going to start gathering those documents up front from the consumer, knowing that they're moving forward to purchase. So by the time a lender, they will be ready to say, hey, I'm ready to talk with a lender. We already have their bank statements. We already have their pay stubs. So with the buyer's permission, we can transfer all that stuff to the lender. It's just going to make it such a more streamlined, smoother transaction. There's our machine learning is it takes time to kind of build that out. So we're going live in September. Over time, we'll be improving on that machine learning. This kind of talks about some of our revenue models, different ways we can pull money in. We can charge per lead that the lender gets. We can charge like a pay per click kind of thing for like leads that are like on the website. Maybe it's Bank of America is they're paying to advertise, and client clicks Bank of America to Bank of America. There's just a revenue streams. Hybrid is something we're still kind of testing than just ad sales in general. So again, we are a startup company. We're looking for around $500,000 to fully develop our site. We'll have a minimal viable product mid-September. We have a couple of investors that we're talking to, and what I'm looking for today is really feedback on our system, or feedback on this idea, and just if you know of any investor opportunities that to get us in front of some other investors, or if you have some investment interest, then we'd love to talk with you too. This is just kind of some investment options, or just kind of some ideas that we've had. And this is kind of the team that we have. Brian Young is our CEO. He was actually in Bloomberg's magazine, but he was like the top. Let's see, I guess it probably says up here. Before he was 20, he started his first company when he was 17, too young to even incorporate the company. He sold his first company before he was 20 for $5 million. So he's our CEO. He's now like 27. He's a smart dude. And then I'm just a mortgage guy. He's like that's why he's the CEO. And then Stephen Better, he's a lot of underwriting experience. Then we've got our technology guys that are on our team. But this is what we have, and that's my presentation. So what questions do you have?
I've got a couple of questions.
Sure.
So you mentioned your market was basically somebody with a subpar credit score.
No.
So less than the average, so 600, right? What would you do for somebody that had the normal credit score, the average credit score of 760?
No, it still helps. It includes everybody.
Okay.
It's all inclusive. What I was saying about the lower credit scores is just that it's an underserved market. I mean, 680 is not a bad credit score. You can get a great rate with 680. 650 is not a bad credit score. 640 is not a terrible score. You can still get 100% financing, with that. But a lot of people just don't realize that. And certainly, if you can get 100% with 640, you can get 100% with 780 too. Our target market is the millennial and the Gen Xers and the Gen Zs and even baby boomers who are embracing the technology, the online, the great grandmas and grandmas that are now dealing with the phones and embracing technology. The millennials already embrace technology. The Gen Zs embrace technology. Gen Xers are for sure in there too, but the millennials is over a third of the market right now in purchase money. So they are our biggest target audience is the millennials.
Okay.
But it's not limited to just lower scores. It's good feedback because I need to change the way I'm describing this because that is not our target. Our target is all inclusive. Anybody who has interest in home ownership.
Second question. So with the hack of a major repository such as Equifax, security and our credit information that's been exposed, what will you do for security? Because you're asking for all these bank statements and
We have the same security protocol that any company online would have for.
such as Equifax. Sorry.
Yeah, I hear you. Such as Equifax. Yeah.
Okay.
So there's the Graham-Leach-Bliley Act, which is it's a client security. It's a 100-page. It's over 100 pages of ways we have to secure the documentation, on-site audits, firewalls, and all this kind of stuff. I'll back up here. So 65% of the monies that we're looking to raise is for product development, and 15 is for regulatory and legal. So I mean it's
You're going to protect the information.
yes. I mean, it's a $50,000 audit. Each time we're audited, it's $50,000 audit just to verify that we have the proper securities in place. So yeah, I mean, we're definitely. I mean, that's a big piece of all of this is being able to secure all that information. And then there's like these authentications that we have to do for the consumer. Just like you're starting to see like we're going online. It's like, hey, we text something to you. Give us this verification code. We have to do all that same type of things too. So, yes, ma'am.
Okay, so let's go back to what Mr. Sherry was getting about your revenue stream. Mm-hmm. I get that if I'm a consumer, I go in and I'm interested in this, I raise my hand and say, hey, I'm interested in XYZ to be my lender. Okay? Are all of those people who are my options already agreed with you that they're going to pay you, or are all of these just potential people and I pick one and you've not had a negotiation with them?
They've all agreed to pay us. They've all agreed to pay us.
So right now, my pool, though, is just people who agree to pay.
Mm-hmm.
Okay.
It doesn't mean you have to use the people that we recommend through through our portal. Mm-hmm. But if you just say, all right, well, I'm just going to call somebody else, it's totally fine. It's a free service to the consumer. They can still educate themselves on, hey, this will be a bond loan that I need to do. So then when they reach out and make phone calls to somebody outside of our pool, then they would be more educated. Hey, do you do a bond loan? And they would get no from probably 8 out of 10 lenders that they call.
So you're being paid for the recommendation from the lender? So I'm confused. So if you recommend three, they would qualify for 3 different lenders, and they only choose one. Are you being paid for all 3 recommendations, or just the one? Okay.
Just so there's 3 different revenue streams. One's advertising on the site. One is when they actually say, hey, I want to click, or I want I want to go with this lender. I want to talk with this lender. And then the other is a hybrid model, which is kind of, I didn't really get into it because we're kind of going through our regulatory stuff, just compliance, make sure that even whoever thinking we can do it is in compliance with banking commission and CFPB and all that.
I think it's a great idea. I think that technology is revolutionizing the way that we conduct business. So I think it's a good idea. I just, I was worried about the person that could get the traditional loan pretty easily with a higher credit score. So if it's all inclusive.
So a lot of people, even with higher credit scores, think that they may qualify for a traditional loan, but they think, well, I still need money down. Or I need more money down than you really, like you can get a conventional Fannie Mae loan for 3% down. A lot of people don't realize that you can get a conventional loan for 3% down, which is, 7. I mean, I talk to people all the time that say, I'm not really sure about my credit. I pull the credit there at 700 plus score. A lot of people don't realize that they have good credit. Even those that do realize they have good credit, and even through our site, there's scoring, there's credit rates too that are provided. So each lender is providing their average rate that they're offering at the time. So the consumer would get, okay, well this is, this lender is in this rate range. I'm gonna call that lender. Yes, ma'am.
How many lending companies have signed up?
We have 4, actually 5 that have interest. Again, this is still development. We won't be live until September, and even then, we're going to test it with only 1 or 2 companies just to make sure everything is working like it's supposed to. The feedback is like the outputs are correct, and so really just 1 or 2. But we have Nations Lending, Annie Mac, PFG, Barclays, Wells Fargo. They all have expressed interest. We're talking with Wells Fargo in September after we have our MVP in mid-September. So we have, and you know, I'm currently lending now. This is super exciting from a lender side to be able to have a good quality lead that you don't have to. I mean, that's already been scrubbed. The guidelines have already been scrubbed. You already kind of know what you're getting. It's from a lender's perspective. I think it would be great from a lender's perspective. I think we can get any lender we wanted to. I mean, I could probably make a call about any lender and they'd have interest in it. So, but those are the 5 that we have interest in, that we've talked to that have interest. So, any other questions?
Not a question, but a comment.
Yeah.
Just the fact that you are educating the consumer and shortening the buying process,
Mm-hmm.
I think it's all about relationships. So in doing that, and they gain that very piece of information, I think it'll be vital.
Mm-hmm. Yeah, I mean, that's, just in the consumer having confidence in what we're providing. And then over time, our ratings as a company, increasing and would help with consumer confidence too. Yes, ma'am.
Regarding funding for you, have you talked to an angel investor group?
Have we talked to an angel? We've talked to a couple, yes. Yeah, we are in negotiations with a few. We're only this initial stage. We're only looking for. We've actually had some offers of over $500,000, but they're wanting a higher percentage of ownership. We're not willing to give that up. So we're looking to be in that $500,000 or less. That'll give us enough that we can roll out to multiple, add states and retain and not dilute our ownership interest too much in the company.
So Joey, what can this community do for you? Besides give you some money.
Share our site, share Home Lending Pal.
Get them before investors get you in front of
Get us in front of potential investors. Yeah. Yeah, I mean that would be very helpful.
All right. Thank you so
All right.
much.
Thank you.
Good luck.